Garrett Nelson is an equity analyst at CFR Research covering the autos, joining us here. We'll also do some trading with Tom White in studio in a sec. Garrett, great to have you back on the show. What are you looking for in motor vehicle sales today? I mean, we always get a bevy of numbers. What's the most important to you?
So overall, the U.S. market has kind of hit a soft patch. We think the market's going to be down about 1.5% new vehicle sales in 2019. So, the automakers used to report their monthly sales data. Now they've all shifted to reporting just quarterly. So we'll get the quarterly numbers in early January. But GM's sales are down about 1% year to date. Fiat Chrysler down 1% also. And Ford's down about 3.5%. So, the U.S. market down 1.5%. That's much better than the global market, which is down about 5% so far this year, really driven by China, which has fallen by 10%.
Now, when we think about the U.S.-China breakdown, Garrett, is there a story domestically that might be able to find strength in the activity of the consumer, or are they still just not buying the cars that are available?
Yeah, I mean, that country has had a streak of 3 decades of growth. I mean, if you look back 30 years ago, they were selling less than 1 million vehicles a year. Now they're selling close to 30 million vehicles a year. So we think the tariffs are having an impact. The Chinese consumer just has pulled back on their spending overall. And we think the economy over there is actually a lot softer than the economic numbers that the government is publishing.
Domestically, Garrett, is there hope that we see in what we see for the housing market picking up? The consumer spending activity remains very strong. What's the catch here when it translates from the domestic activity into some of the stocks for the traditional automakers? Is it just that the domestic situation pales in comparison to the gravity of China's slowness? Or is it that people here just don't need the traditional cars, or they're not interested in the style, or they'd rather put the money elsewhere?
Yeah, so there's a few things happening. Obviously, the consumer is very strong. We're seeing that across the economy. So people are spending, but there's a demographic shift taking place where used vehicles continue to take share of the overall auto market. So, new vehicle sales just aren't as robust as they could be. That said, we're coming off a 4-year period where U.S. new vehicle sales have been above 17 million units. So that's unprecedented. That's never happened before. So we think the U.S. market was kind of was going to have a slowdown sooner or later. And, we think that overall the year will come in just under 17 million vehicles, which historically is still a very strong number. So it's not like the market has really dropped off. You're just seeing some softness in sales, and the tariffs are not helping margins for the major automakers.
Speaking of tariffs, Garrett, I'm just going to take that opportunity to jump in real quick because headlines broke. Fox reporting that the December 15th tariffs are still on as of now. U.S. still going forward with the tariffs is the report that just helped stocks make a new low on the day. Garrett, if we do see continued escalation, your point here is that for the China demand on autos, this is not helping.
That's right, and it hurts the automakers in terms of raw material costs, steel, aluminum, those types of things, but it also really hurts their suppliers. So, it'll affect the entire auto supply chain and will really continue to weigh on margins. I think, the auto stocks had rallied recently in hopes that a deal would be reached, but now, it appears that those tariffs are going to go in effect, so that's not going to help overall investor sentiment. These stocks are trading, if you look at GM, Ford, Fiat Chrysler, they're trading at, anywhere between 5 and 7 times forward-year earnings, which is just some of the lowest multiples of any industry. But we just don't see much of a catalyst in terms of multiple expansion or earnings growth going forward, given that we are so late in the economic cycle. The best time to buy these stocks historically has been early in the cycle.
Garrett, what about Tesla? We just heard the bullish note from Piper this morning. Can they be uncorrelated to some degree to these macro trends, or at the end of the day, are they a car company, or are they going to be able to find incremental growth in their own business model and their tech side of the auto space?
Sure. So Tesla, it's really a different animal. You look at the multiples at which it trades, which are roughly 10 times the multiples that the big three U.S. automakers trade at. So it's being valued by investors as a really a high growth technology company, and we think that's appropriate. That's how it should be valued. That said, we just don't see much more multiple expansion from here. It is trading at roughly 60 times estimated earnings next year. And it's really hard to argue for a higher multiple, especially given some of the headwinds that they're going to face, namely increased competition. So we expect 25 new electric vehicles to debut in the U.S. next year, only one of which will be a Tesla vehicle, the Model Y. So, that competition is coming. It's right around the corner, and that's really going to be a problem. There's also questions regarding their margin improvement and how sustainable that is going forward.
All right, really good setup here for us. We're going to do some trading here on the companies. Garrett, appreciate you joining us as always. Garrett Nelson, equity analyst at CFRA. Let's start with Tesla. Tom, after the big jump Tesla's had, it's kind of now like a report by report stock where it has big gaps. There's obviously trading in between, but after what we saw, how do you sort of approach this from that perspective where, look, maybe it doesn't have to get dragged like the rest of autos with all this tariff stuff, but maybe it just kind of plateaus until our next big report?
Yeah, and remember, we've covered this name for years where before start of 2019, this thing was in a pretty tight range for months at a time. And if you expect that to continue, there's option strategies that you can take advantage of that, especially today where Tesla's barely down today, and you got the overall market down over 1.1%.
Right.
So that's a concern right there. But what if it does plateau between that $360 level?
Okay. So we're looking at Iron Condor.
Iron Condor, but I skewed it a little bit to the upside here, so I don't have as much risk to the upside. So Iron Condor, selling it, basically 2 short verticals in here. And what I looked at was going out to the December cycle, about 17 days to expiration. Selling the 310 puts, buying the 305 puts, that makes me risk defined on the downside, but it gives me more risk because I've got a $5 wide put vertical. But then I'm only selling the 350, 352.5 call vertical on the upside. So I collect roughly about $1.50 credit for that. That gives me $1 worth of risk on the upside because my call vertical is only $2.50 wide. Now, my put vertical being $5 wide makes my risk about $350 or $350 per spread to the downside, but I've got nice cushion to the downside of $308.50 on the break even, and then my upside break even is about $351.50 on that trade. Now, you collect $1.50 credit. That's the most you can make on that, Oliver, but time decay and theta actually helps in this type of trade where the value of this Iron Condor, as long as it stays between those two break-even points, contracts in value.
308 and 355, which is a pretty handsome range there.
Yeah,
okay.
Exactly. But
even by Tesla standards.
I think by unbalancing this to the upside, if you have any concerns where we might get another pop to the upside, you've got a lot less risk on this one. You've only got $1 worth of risk or $100 per spread to the upside on this. So that's
you don't want to see new highs in this trade, basically.
You do not.
Yeah. All right.
Or you don't want to see it start to fall back towards 300 either.
Okay. What about if we go on the more traditional, the kind of legacy names, okay, as we hear the impact of tariffs and just general tension between U.S. and China is not good for names like Ford and GM.
Right.
To Garrett's point, we see GM down 1.7% this morning. How would you approach this?
Well, if you look at just GM, it's starting to tighten up in a range over the last several weeks, and it's up 7% year to date. If you expect that to continue to be range-bound trade, I looked at another strategy, just using options. Now, if you're bullish on a name like GM, you can buy the stock, maybe create a covered call strategy to kind of enhance your yield on that type of spread. But I looked at another Iron Condor trade, but this one's referred to as an Iron Butterfly because I sell the call and the put on the same strike in December. I'm going out only 17 days. Really short-term trades I'm looking at today, Oliver, just because that increased volatility we've seen in the last 2 sessions. But you sell the 35 call and put in December, and then to protect to the upside and the downside, I buy the 33 put and buy the 38 call. So each vertical on this, call side and put side, is $2.50 wide. You roughly collect about $1.30 credit, maybe a little bit more. Your break evens on this one, $34.20 to the downside and $36.80 to the upside. Now, it's not as wide as that Tesla one, the Iron Condor, because I'm selling that same common strike. I would just, if I was looking at this type of trade, I would expect that GM would have a relatively 1% to 2% tight range over the next 17 days until expiration. And the risk on this, because each vertical is $2.50 wide, is about $1.20. So your risk reward is pretty good on this trade, but you just need it to remain in a tight range, get some consolidation in this name, and then that decreases the price of this Iron Condor or Iron Butterfly, where you can buy it back cheaper.
All right, there we go. Range-bound trading in autos, S&P 500 and NASDAQ right now trying to find a bottom on the early morning open, but we're still fresh in this trading session and stocks are under pressure.